Thank you all for attending today's sessions. Today we will be speaking about Indian market May update and what investor need to do in this current volatile market. As we speak, we have seen that Sensex has dropped from 62,000 level a couple of weeks back to hovering around 52, 53, and Nifty around 16,000 level. It has breached 16,000 level last week, and it has resumed at here. So we will discuss what exactly is going to happen in Indian stock market and what you need to do with your existing investment. Okay, I will speak more of the data because data is something which is supreme, and we have gathered data from different sources, and most of the sources are quite genuine because the data has come from the world biggest data bank, which is a Bloomberg. So you can rest assured about the data quality and as such. So we'll present you the data, and you can able to understand what is going to happen in time to come. Okay. Yeah. Okay. So our pattern of presentation will be the same. We'll speak about global economy first, followed by the Indian economy, and then we speak about Indian stock market, and followed by the Indian debt market, and what as an investor you need to do. The sessions will be around 30 to 40 minutes of time, and if you have any questions, if you have any query, I know most of you, I can see that they know me personally. They can drop me a message later on in my WhatsApp. I will not be interrupting in between because I will let the flow to continue so that you remain with me during that time. Okay. So talking about the global economy, war has actually set back the global recovery. If you see the data, it is estimated by the IMF in 2021, world output will be 6.1, and because of the ongoing Russia-Ukraine war, the just a minute, I'm very sorry. Just a minute. I'm extremely sorry for that. Because of the ongoing war, the projections of the world output has reduced from 6.1 to currently it is 3.6, and it is projected 3.6 onward also. If you see the all advanced and the emerging economics, we have the same pointers as such, where the current estimates you can see, and you see the projection onwards, and this basically has happened because of the war. Moving ahead, global growth optimism is at all-time low, which is quite evident across the globe. We have seen a strong equity selling across the globe, not only in Indian market. Indian market is a slightly different, which you can able to see once I go on with further slides. But globally, we have been seeing the equity market is correcting a lot because optimism is at all-time low. We are talking about global right now. Equity and debt selling in the same boat. So when we see that equity and the debt market all across the globe, they are at a selling speed. I'm talking about the global market right now. I see the data is clearly showing that thing. In the April onwards, April also, we have a huge selling happen in equity and the debt market. And equity across the globe is correcting, as I mentioned right away. If you see the Nikkei, this is CY22, and black one is a YTD data, April YTD data. So if you see the Nikkei, UK, Europe, US, all across the globe, the equity market is correcting. Okay, so it is not a new thing that only India is happening. That thing, it is happening across the globe. Bearing Indonesia, we have seen the most of the market is correcting in Spain. US stock in real term on course for the worst annual drop in 1974. If you see the US stock market, if you see the data in 1974, actually it has gone much deeper. And right now it is in 2022, we have not yet finished 2022 itself. And we have seen a huge drop in the US stock market real return. So that's what happening in US economy. NASDAQ suffered heavily. The data is evident. More than 50% of the stock in NASDAQ, 45% of the stock is NASDAQ down 50%. More than 22% of the stock in NASDAQ is down 75%. And more than 5% of stock in NASDAQ is down 90%. That's a huge data point that I'm telling you. So NASDAQ has suffered heavily. And we know that what is happening in the IT stocks also. In India as well, we have seen the IT stock has been has hammered heavily. We have been telling this thing, last session also we have told that remove from the IT sector if you are already exposed to that. In fact, in the IT sector, the reason why it has happened across is that I have been couple of clients in the IT sector also, they have been telling that there is a huge attrition level going on. If you see the Infosys data point, they have a 28% attrition, similar with the TCS also. And I have smaller clients, they are saying that yes, the attrition rate is high. The reason because the IT sector people, they are, the employees, the major cost of IT sector is the employees. They're charging huge. They have a huge employee, huge pay hike as such, and which has deeply impacted their profitability as such. So that's what happened in the IT sector as such. Otherwise, with rupee depreciating, IT should have been much beneficial because India is the net exporter of IT. Okay, but what happening because of higher attrition, higher input cost, vis-a-vis the employee as such, this has affected our DP. Coming back to the global thing, which is evident from here, in Nasdaq, as I showed you already, the data clearly says that it has suffered heavily. FANG reported flat revenue growth. The FANG is that index. We have the FANG index. Couple of investors in India, they can invest in FANG index also, but RBI and the SEBI has limited that FANG index investment in India from the January onwards. Couple of my investors who are invested in FANG, they are aware of it. FANG is basically an index where we have all the top companies like Facebook, Amazon, Apple, Netflix, Google, and all those things. There are 10 companies in the FANG. And this FANG, which is the topmost company, top 10 companies in the globe, as far as the market capitalization goes, they are having, a lowest ever 2 decades flat revenue growth. And that is why if you have invested in FANG index, your actual investment value is less. It has decreased by 20-25% right away right now. So that's what happened. Because, and the interesting point is that, why this has happened, because it's Amazon, Apple, Netflix, Google, and all. You might be hearing about the news that Netflix is losing subscription very rapidly across the globe because of its competitors. Facebook has also dropped much below. But very interesting point is that Facebook is cheaper right now than if you talk about Infosys and other IT companies that operate in good IT companies operate in India. Facebook PE ratio stand around 15 to 16 as I speak to you, which is very attractive right now. So they have corrected very deeper in recent times. The reason why, because for the last 7-8 years, if you see the revenue growth, if you see the overall growth of all those companies, it's phenomenal. They have been moving in a linear direction, in one direction, and this is, I think, is a very good opportunity for them to get corrected, and for investors also to enter into those kind of stocks which I am mentioning right now in the FANG index, especially because they are available at much cheaper price right now. So moving on, commodities, this is a very important data point. Commodities at all-time high due to geopolitical risk. We all know about the commodity, iron ore, steels, metal, and all those things. They're high. If you see the data of commodities taken from 1995 to right now, the rise of commodity price. Now, this has been the sharpest ever commodity price rise in the world, led by the Russia-Ukraine war. But notice very clearly that commodity itself will always fall down whenever it rises. If you see the trend for the last 30 years, you will see once it rises, then it fall down, it will rise and fall down. And now I presume that commodity price is at the peak and it is about to fall down from this level itself. And that is why if you have invested in Tata Steel recently, you might have gained a huge. But Tata Steel is basically about steel prices. They do not have a brand of their own. The steel rises, the prices rises of that thing. So I'm expecting a huge, deeper correction in the commodity price very soon, probably a couple of months from now, at least 20% from here. So if you have invested in any of the commodity companies, so you can book your profit right now and get away with it, because you will going to see a deeper correction in commodity days to come. When I'm talking about why the commodity correction will happen, and since we have knowing that the commodity price has gone high. Now, I'm talking about a global perspective, because India doesn't in this particular index. This is actually a London index, which actually captured the overall commodity price movements across globally. You see, there has been they're talking about Europe in recessions. US is having a degrowth kind of thing. China has locked down. So where will the demand will come from? So if the demand will not come from, because of the supply constraint, this commodity price has risen up, it is bound to fall down in days to come. And commodity as such, since inception, if you take the data, if you drag down this data a little longer, like suppose say in another 25 to 30 years, you will see year on year commodity growth is like 2 to 3%. This is an abnormal kind of rise which has happened, and it's bound to come back to that particular level. Okay, so that's what I mean to say. So that is what our perceptions about commodity price goes. It's bound to come down. Commodity outperform tech, which I already mentioned. The data is also showing that, the FANG index I already told you, and FAN is actually acrimony to Freeport, Alcoa, Newmont, Nuclear, and Steel Dynamics. So the index actually said that commodity outperform tech globally. Commodities to equity ratios remain at all-time low. If you see the grade, you see the data from 1970. Now, this is the commodity to equity ratio is all-time low. This is another important point where I already told you that commodity is bound to rise, bound to fall commodity price from this level at once, because this is not sustainable. Okay, so that's what I mean to say. Valuation of non-US stocks back at pandemic low. This is quite evident because I have already shown you the data across all globe. The market has seen a very, very deep corrections. Headline CPI inflation and multi-decadal high all across the globe. So if you see the inflation number, I have been always telling that where will the stock market go? You don't have to do all the calculations. See the CPI inflation number globally as well as in India. You will be able to know where the market will go. So if you see the inflation number, now this is the global inflation number. You see the global inflation number and all the countries, it's all-time high across the globe. And that is the reason why the central bank across the globe are increasing interest rate aggressively right now. And why the inflation is high, it is quite evident, because since from the COVID in 2020, we have seen the huge amount of liquidity inflow into the market, and this number is actually waiting to come. So since there was so much of liquidity in the market, we know there is a supply constant. Demand will not be high because of all those things happening in the globe. The commodity price, the inflation is going too high. But with central bank of across the globe, they are increasing the interest rate. You will see the inflation will gradually, it will not rapidly, will gradually come down. Because as I mentioned, demand will not be there, because globally I'm talking about, because US in recessions, Europe in recessions, China is shutting down. There is a huge crisis going on in the Europe with Russia and Ukraine, all those things. So demand will not be there aggressively. And so this once the liquidity sucks from the market, you'll see this inflation number coming down. What happened, you might be aware of, is that last week RBI has also increased the interest rate. If you talk about India, it has actually sucked 40,000 crores of liquidity from the market by raising 0.40 basis point interest rate. And obviously it has done, couple of days back. Last Thursday, as we are speaking of Saturday, last Thursday, the inflation number of India has come, which is around 7.5% to 8% level. So which is an all-time high, okay, which is all-time high in a couple of years back from now. And you know why I'm saying this thing? Because RBI governor has a very clear-cut mandate that you have to keep inflation number between 2 to 6%. That is the mandate. Like we all have our KRA when we're working in organization, right? RBI governor also have a KRA. Now he has to maintain the inflation number between 2 to 6% CPI. Now what I said, that inflation right now is 7.7%. If 2 quarter the inflation number is above 6% or below 2%, RBI governor has to go to the parliament and speak in front of every MPs out there in the parliament, give explanation why the inflation he is not able to maintain. And if the parliament is not satisfied, he will be sacked and new RBI governor will come. That is the importance of inflation number in India right now. So that is the reason you have seen that between the biggest ever IPO in India, RBI governor has increased interest rate. It is unheard of. Okay. But anyway, moving ahead, so we've seen that interest rate is increasing, and central bank tightening monetary policy I've already mentioned. If you see the data very carefully, this is the hikes, this is the cuts. If you see in 2020, all the central banks are cutting down the interest rate because they want to spike the economy from the COVID surge. And now gradually, if you see the hikes are happening, the hikes, all the central bank across the globe are happening, and the cuts are reducing. So that's what happening. It will this graph will increase more as we go towards more later half of this year. Even I will say that in India, you can expect another 50 to 60 basis point interest rate hike from here on in next 3 to 4 months, if that 7.5% interest rate not reduces further. But I don't think that it will reduce that much faster. So you can expect another 50 to 60 basis point interest rate hike from here onwards. Moving on, emerging market yields are hardened less than domestic market. Well, I will not spare much time on this thing. Stock of negative yielding debt payment. Okay, we'll move on from here. US economic contracting, I already mentioned you earlier also. If you see the quarterly analyzed data, this time the US economy has actually contracted. I told you that US economy is in a degrowth phase right now. So that's what is global economy is about. And on a nutshell, we have seen that the global economy is US economy and the global economy is contracting. The market is giving a negative return across the globe. The CPI inflation is extremely high across the globe, and so is the commodity price. So what we are expecting globally is that we don't know about where will this war will heads to. We don't know whether Putin will start a nuclear war. If it happens that if nuclear war starts, the crude and the commodity price will again soar to a record level. And if the wars ends very soon and Russia US lift some sanctions on the Iran and Middle East, you can see the crude and price can go much lower. But these are the two extreme I'm talking about. Putin waging nuclear war or continuing the war for much longer. But giving the momentum, if we consider that situations remain status quo, because we cannot say for sure how long the war will continue, but we can say that if the situation remains status quo, then I presume that commodity prices will certainly come back. We can see an expected fall of 15 to 20% in the commodity price globally in days to come. And inflation, with the central bank across the globe hiking interest rate, I presume that inflation will come down, probably not right away 1 or 2 months, but 5 to 6 months from now on. And that's a huge thing. Okay, but yes, for the coming 5 to 6 months, you can see a much higher, a sharper, monetary policy from across the world globe happening. And whenever the interest rate rises, whenever you have a higher inflation rate, the stock market will not give you a linear upside growth. That's, you have to be very clear about that thing. Okay, so that's what is global economy is about. Coming back to the Indian economy, let's see what's happening in Indian economy. See, this is the April data. India's tax revenue soared to an all-time high of 27.7 trillion. Indian export touches 670 billion. GST mop up this huge. Indian activities here spike. India gets its 100th unicorn startup as Neobank Open crosses billion-dollar valuations. Fast-track toll collections touches 4,218 crore. Luxury home sales its 3-year high in first quarter. Okay. So all the data points which I'm talking about in India is extremely positive despite what is happening across the globe. So as you move ahead, if you see the progress indicator of India in globally, the economy size in 2014, we have increased from 10th to 6th rank right now. Share of global GDP, we have increased also 2.6 to 3%. If you see the auto production, steel production, mobile phone production, every other parameters in the last 7 to 8 years, India has improved immensely. Okay. Economic activity right now is an all-time high. This numero index is saying, and we have this global gradual recovery across all high-frequency industry, GST collection, power, rail fares, TV sales, and everything. We are having a huge recovery happening across all spectrum. Credit growth is reviving. The data is clearly saying, during the demonetization and the GST implementation, it has gone down, and now it has sharpened moving up. And then it's COVID time, we have again see the credit growth as going down, but now it has recently spiked. Okay, this credit growth is important because that's where economy will grow. That's where more job creation will happen. That's where the more the company will grow as such. So we have seen a recent hike in that thing, and I'm expecting this number 10%. As we speak, 2-3 months down the line, your market update, keep mark my words, it will go around 16 to 17% from here. Okay. Indian corporate balance sheet at leverage in recent time, corporate debts to GDP, which is a good sign. And asset quality improves to highest this decades. Okay. A ratio of higher than 1 denotes more upgrades than downgrades. Okay. An increase in ratio as compared to previous period denotes an improvement in credit quality of rated entities and vice versa. So you can see that the asset quality has increased this time in India. GST collection, I already mentioned, which is the highest ever GST collection in the month of April, which has happened. And this is good because the government is getting more revenue out of it. IMD predicts a normal monsoon. This is a very important data point because the monsoon plays an important role in India itself. And this time IMD predicts a normal monsoon. That's a good sign for agricultural sector, and we are totally dependent on agricultural sector. During this COVID period also, the sector which actually helps India GDP to remain, do not go below at par, it's that of agriculture sector. Indian resilient to ongoing war against emerging market. See, the important point is that the people are talking about the war and what is there is an impact on the India. If you see, the overall exposure India to the war, the kind of impact India is in 12th, and Turkey has been impacted badly. If you see the Turkey's inflation number, you will be surprised to see, I have a slide in that thing, they have a 70% higher inflation number. If you Google out the Turkey's inflation, you will see the 1 year back, what's the price and what's the price right now, you'll be able to understand. Because Turkey is very, very much dependent on this Russia and Ukraine crisis and all those things. Capital flight, risk exposure, you will see that India exposure, net energy export, net grain export, trade and investment exposure to Russia. You will see the India is 0.28%, Turkey is 2.6%. So that's why you can able to understand that why I'm saying all those things. Like so very negri impact of India as far as the Ukraine and Russia war going on, bearing only one thing, which I will be telling in next slide probably. Yes, that is at crude oil prices. Now, this is the important slide because India is, whatever things you do, India is a net exporter of crude. And that is the reason, because of this crude oil, higher crude oil prices, 110 approximately, moving around over 100, India has impacted deeply. Because being a net importer of crude, what happened is that because of this higher crude oil prices, India's forex reserve, India's export-import ratios got disturbed. So that is the reason why you're seeing that the market has impacted and reacted in that way. And I always tell you one thing is that, stock market do not react what is going to happen today or tomorrow. The prices which you are seeing right now, I always tell you, remember very clearly that it is a reflection of what is going to happen 8 to 9 months ahead of ours. So stock market always thinks 8 to 9 months ahead of time. I have been telling this thing in all my webinars, and I will stick to this point. So whatever is happening today, stock market actually is factoring 8 to 9 months ahead of our time. Why I'm saying this thing? Because of the higher crude oil prices, it is going to impact most of the company's balance sheet. We have a net rise in the input cost. So whenever we have a net rise in the input cost, you're going to see the profitability getting a little bit hamper in that thing. So whenever the profitability is going to hamper, because all the input costs will rise because of the higher crude oil prices and subsequently higher inflation rate. So actually the price, the balance sheet, the profitability which will come across in next quarter or next 2-3 quarters from now, you will going to see a slight degrowth as well as the bottom line goes. And that's what stock market is factoring for the next 8 to 9 months ahead of our time. So don't think that today, what is happening like 52, 53,000 level, and because of that, it has already factored out this thing. But with government increasing the interest rate, with sucking out the liquidity from the market, and as I already mentioned, where will the demand will come from? You're going to see this inflation number probably in a couple of months from now will cool down. So probably in 6 to 7 months time, you will going to see what is going to happen in the stock market. I will reserve my comment on this particular aspect, Indian stock market, in a slightly later right now. So let's move on with this particular slides. Impact of rising crude on macros. As I mentioned, that GDP growth, see, a 10% rise in cruise impacted -20 in GDP growth. CPI inflation plus 0.5, 0.4, and current account deficit is 0.30. So that's the impact of crude. So crude remaining above 100 is going to impact huge to India. It should hover around 80 around. But what I mean to say that, I always tell that crude, so I go back to the previous slide. So this is a slide, and mark my word, in 7 to 10 years from now, this crude 109, you're going to see the price about 20 to 30 only. Why I'm saying this thing? Because crude will not have a major impact. If you have invested in ONGC and all those companies, well, if you are making profit, you can book out the profit right now, because 7 to 10 years from now, things are going to change drastically. In India, ethanol oil has been aggressively moving on, and India is moving aggressively towards electric vehicle right now. If you go to Europe, like 20 to 30% of the Europe they have moved towards hybrid and electric vehicle car. In India, probably it will take a longer time. In Europe, in next 2 to 3 years, you will have a higher amount of electric and hybrid car than the petrol and diesel kind of thing. And in India also, probably next 10 to 15 years, you're going to see, I can assume that in next 10 years, you can see most of the car going to the electric or a hybrid model kind of thing. So EV vehicles, so there are government incentives coming up for the EV. You can get a tax benefit if you buy an EV car also, apart from the ATC and all those things. So there are a lot of incentivized going on across happening, and India is aggressively working. But that, I presume, will take 7 to 10 years from now. And probably next 3 to 4 years, you will not find the car manufacturer manufacturing a petrol diesel engine. You will find a car manufacturer, manufacturing those EV and hybrid car model kind of thing. So what will happen to the oil price then? Okay, so oil price, we already get an alternatives, right? So that's why I'm saying that that is a good positive thing from India, because from a longer perspective, because India is a net importer of oil, and once we move, probably 100% movement will not be possible. But even if a 10 to 20% movement from oil dependent vehicle to the non-oil dependent vehicle is a huge impact from India. So that's why I'm saying, in a longer term perspective, we'll see this is a good perspective from India as they are moving towards EV and other vehicles. So moving on, so we'll talk about the Indian equity market round. So we have discussed about the global market. We are talking about the Indian market. Global market, we have seen extremely negative things like market is going down. But as far as the Indian market is good, I have showed you the data in all parameters. Bearing crude, India is performing extremely well. Okay, and because of the crude, the market is factoring the prices way in advance than 8 to 9 months from now. And that's why you have seen the correction right away. Okay, so moving on to the Indian equity market, small cap and mid cap has outperformed large cap in last 1 year, so which is quite evident from the data point which you have seen. And as far as the sectoral performance, I already mentioned, it's the YTD data. IT sector, you already seen minus 18%. You see the energy sector has risen 26%, metal, bank, FMCG, private bank, and auto, and all those companies are risen. So I will going to park my comment later on which sector you should look out right now for investment. Wait for that at the last. Okay. India's worst FII selling since 2008 crisis. Okay, so another reason is that why the market, I have told you one reason is that because of the crude, market is factoring 8 to 9 months advance of the prices. And second reason is FII selling. Okay, FII selling has been huge since the inception of the stock market in India. This is the highest ever FII outflow that has happened. But despite highest ever FII outflow, market has not fallen from 62,000 to 53,000 level. At 15% level, market has corrected. But if you remember in 2008, when the subprime prices happened, that's what in 2008 what happened. I just show you. Yeah, this is the 2008 data point which has happened. FII outflow was 16 billion that time. And right now, we have not completed the calendar year also, we have already at 21 billion. So if you can see that time, if you remember, market was at 21,000 level and has corrected to 8,000 level. That was a sharpest, that was the deepest correction that can happen, like 50 to 60% market has corrected. Right now, despite FII pulling out so much of money, market has only corrected 15%. The reason why? The reason is the DII flow. There's been a huge amount of DII flow in India. You see the FII flow. FII has been constantly, downpouring from the Indian market, while DII has been constantly putting out money in the market. DII means domestic mutual fund industry, insurance, your participations of stock market, and all those things put across. So that's the data point. More precisely, if you see the net investment, if FPIs, foreign participant, and mutual funds, if you can see that mutual funds, DII, and including all those things. So you see in October to April, they have minus 1,65,000 crores. Sorry. Whereas mutual fund has increased to net input is 1,40,000 crores. That is the reason. Net Nifty changes, you can see that is the reason the market has not fallen down drastically. The total market share of the FII in Indian market, free flowing Indian market, is 23%. So right now, it is, if after this FII outflow, it has reduced to 18% right now. In 2008, when the subprime crisis happened, if after FII reduction, it was 19%. So this is the highest ever time. This is the this is the time when FII is having a very lowest amount of investment in Indian stock market, because they pull out the money and go back to the Europe, go back to their respective country. So that's what happened. Now, when the market stabilizes globally, what do you think they will go into invest? They have only two countries, India and Brazil. Okay. So imagine when the FII coming back with those kind of 1,65,000 crore amount of money again to the Indian investment, their percentage of 18% will move to the 23%, which is the historic average for the last 30 years. You can imagine where will the stock market go from here. Market is, I have already mentioned, market has already corrected. Probably it's 7 to 8 months time, considering the COVID and inflation impact is there. Probably you can see a little bit more correction happening out here. I cannot presume what is the bottom line. So you can see a Nifty at 15,500 or 15,000 level also, and stock market at, and Sensex around 40 to 50,000 level. But I cannot say presumably that thing. So in a shorter term, you can see a little bit more volatility, because as I mentioned that market is also expecting there is a rate cut happening, a rate hike happening to the tune of 40 to 50 basis point. I already mentioned that. So if that happen in next quarter, you can see a little bit more deeper correction, but not very deeper correction. Below 15,000, I'm not seeing. Yes, if Russia invaded Ukraine by a nuclear bomb, it can happen much deeper also. But that is a remote kind of extreme kind of situation that we're talking about. But if that do not happen, if everything remains status quo, you can expect Nifty to go around 15 to 15,500 or Sensex around 48 to 52,000, hovering around this point. Probably next financial year in 2023, I am expecting a huge jump from here. Okay, 70,000 expected. You can note down my part and you can speak to me next year, October, November, December. That's what you have told me that thing that time. So I'm expecting market to reach 75,000, 70,000 level across probably 2023 and onwards. Two reasons why is that one, I can assume that that inflation numbers will cool down, commodity price will cool down, and FII will come back very sharply from here onwards. DII flow has already been there itself. So as an investor, I will suggest you that aggressively start investing in equities, not on one go. Okay, so if you have X amount of money, if suppose if you have 100 rupees with you, do not invest 100 rupees right away. So spread those 100 rupees in next 4 to 5 months. So probably you can invest 25 in next 4 months itself, so that you can get a fantastic coverage, because we cannot know what is the bottom line out of it. So what I mentioned is that next 4 months, if you have money, go and sharply increase your investment in equity, because this is the time I'm going to see 40 to 50% hike from here on what's in the market in next 2 to 3 years kind of thing. So that's the kind of opportunity you have. People are talking about investing in 62,000 Sensex level, and they're talking about not investing in 52,000 level, which is quite doesn't make any sense. So I show you all the data points. I move ahead from here. DI share of ownership is increasing, and this is the overall share which I mentioned about. So you can see the DI share is increasing also. I already mentioned that thing, and FI share is coming down. India's fared better than its peers. Total return in USD, I already mentioned earlier that India is performing better than others. I will not spare much time out here itself. And Indian valuation premium over emerging market is still very high. Valuation wise, we are neutral weight. Momentum wise, positive. This is the first time. Remember, if you are listening to me very carefully for the couple of webinars, couple of months time, you can able to understand this is the first time we are saying that momentum wise we are very, very positive. Every correction is an opportunity to increase allocations to equity. Okay, market cap to GDP is long-term average. India is 102. If you remember, this number was used to hover around 110, 120, 125 2-3 months back also. Now we have near about corrected to that level, to the 100% level. Normally Indian average is 81%. In that context, there can be a 10-15% more correction, but I don't see that deeper correction happening. But we are reasonably better off than the global GDP, market cap to GDP itself. Okay. And overall valuation is still above fair level. So Nifty price earning is a 1 year forward P is 19.4, average is 18.4, PB forward 1 year is 3, whereas we have 2.7 as a normal. So we are not very, valuations was very, very little above fair value. So we are not very expensive right now at the current level. More hits than misses. Nifty 50 results. If you see the results of the Nifty 50, this is in April talking about either sales growth, actual This is expectation was 17%, actual was 18%. All across PBT, you will see the expectation of 20%, 22%. Profit after tax is also increased. Earning down growth, you have a lesser earning down growth and more earning upgrade. So that's what happening in Indian companies. The company is working in the utmost parameters right now, and they perform till date. They perform extremely well. Now, the interesting point here is that when I show this data point, you're seeing that all the parameters, we have a better PAT growth, we have better sales growth, earning down there less. Then why the stock market has fallen? Okay, so if the data, everything is fine, why the stock market has fallen? So stock, as I mentioned, always remember stock market works 8 to 9 months, 7 to 9 months advance of today's time. They're actually factoring out the price what's going to happen. So you're going to see, as I mentioned, the next 2-3 quarters, this number presumably I can expect a little bit lower than what you're seeing right now, and that's what stock market has already been factored out. So in next quarter, if you see the TCS is always there, because if you see all the big companies numbers are coming down, don't get scared, because the stock market has already factored out the prices out there. So moving on, corporate profit critical to market. So I will not going to go in depth, because I have already mentioned all those points some way or the other. Recommendation: neutral weight to equities, marginally overweight large cap, marginally underweight mid cap, small cap, and neutral weight to equity. So probably what I mean to say right now is that many of the stocks have been corrected to the tune of 15 to 20%, 25% also. So if you find a good company, how to find a good company? Okay, how to find a best select stocks of your own. So I will give you a couple of examples for that. So how to select a good company? You have to see only 2 parameters out of that. Okay, no technical analysis, nothing. You have to see only 2 parameters. Number 1 parameter is look for the return on equity. If a company has a better return on equity, there is no reason that you should not buy that company. Okay, when I talk about return on equity, see, for the example I'm giving you, the Asian Paints. If you see the Asian Paints return on equity is 30% plus over and over years for so many years right now. If a company is consistently giving you return on equity 30% over and over year and year, why do you don't buy the company if the company corrected its price to the 25 to 30%? Okay, so that's what I'm saying. If you see the Nestle return on equity, if you see Havells Indian return on equity, and you see the stock price movement also, from last 15 years, you pick up all the company which I mentioned, they have a fantastic return on equity, and they were mostly this company a zero debt company. So if you need to pick up a good company, find out companies which have a better return on equity. Second, near zero debt company, and third, growth. What is a growth prospect? Here I will give you 2 examples. Now, ITC, for example, ITC for the over a long period of time, it has not grown. If you might be saying the prices have been staggering around at the same level, it said, ITC is a good return on equity. But if you see the growth prospect is not there, because if you see the ITC structure, 60 to 70% of the profit comes from the tobacco industry. Now, tobacco, because of the increasing awareness in the Indian youth, the consumption is decreasing. Okay, there's a lot of taxations, a lot of awareness going on. So the business which tobacco with ITC is operating, although they have other business also, but if you see the balance sheet, most of the profit comes from the tobacco industry itself. So if that is not increasing, how will the growth will happen? Similarly, second example is the Castrol. It is a very good company, very fantastic return on equity, but the engine oil, right now, 10 years back before also, you will have a higher engine oil requirement. But right now, all the auto company which are manufacturing engine, you normally don't require so much of engine oil replacement. So they normally the engine which have been built on, so it can last a little longer also. So that is why the growth prospect of Castrol has come down. So you need to see these 3 points. Number 1 is the return on equity. Forget about the pricing. Second one, look out whether the company is a net debt, what is the cash out there, and third is whether the company is having a growth prospect or not, whether a top line and bottom line will grow if they have a better corporate governance in place. But top line, you need to see what is the overall growth. But I give you 2 examples for that. Okay, and there are multiple other examples. Tata Steel, for example. I know people invested in Tata Steel and Tata Motors. You look for the return on equity out there. You will be surprised to see the return on equity of Tata Steel, but I don't know why people buy the company itself. So I'm not mentioning to recommending anything buy and sell, because I do not because I'm not authorized to say this thing as per the SEBI guideline in open forum. Just I'm giving an example for this thing. If you want to invest in any of the stocks, you need to do your own due diligence. Okay, get back to me personally. I will discuss more about those things. Thank you. So as I move on, now what are the concerns right now? Mostly I've already told what is the geopolitical risk, which I already been mentioned right away, the China, Ukraine, Russia, and all those things happening. And secondly, we have the inflation, which is there, but I hope that will be reduced, as I already mentioned to you. As I move on, we have a key elevated commodity price to wait on the margin. I will still little bit in the slides. Hope you can able to see the slides properly. If you see in a paint industry, crude oil price increase, you see the number out here, and a steel price increase, you see the number out here. So this is a direct correlation with this thing. If you see the paint industry as such, dependency on logistic as a percentage of sales, you will see the dependence on logistic is 5 to 7%. Raw material dependency as commodity percentage of sale is 50 to 60%. So margin movement during the provided periods, you will see that is a negative thing. So they have a flat expectation in that thing. So you don't expect, if the commodity price keep high, you're going to have an impact in paint. Deeper impact in all those red walla point, that is on chemicals, that is on transport operators, steel, cement, aluminum. So when I'm telling this data point, you're aware that which sector I'm telling you not to look out for. So all the red point, which have a deeper impact as far as the because of the higher commodity prices, although it will reduce, but it will have a higher impact on those sectors. But other sectors, which you can have a better impact on because of this current situations. Okay. Equity invest opportunity, I already mentioned to you. Important thing is that this Friday, I'm going to have a sessions on how to select equity stock of your own. As I mentioned, return on capital. How will you find return on capital? There are 6,000 companies in Indian stock market. How to select those 10, 15 companies where we will find the return on capital? More than 20% or 30%, less zero cash. How will you find that out of those 6,000 companies? How will you find which companies growth prospect is higher, which have a better top line and bottom line growth? If you want to know that, I will share you the link for this coming Friday sessions, which is on how to select equity stock of your own. The sessions will happen on 8 o'clock in the evening. It's a 2-hour sessions, and Friday you can register for the sessions and get to know that how you can select equity stock of your out of those 6,000 available in the market. Okay. Now another important point as I move on, I will say that you might be heard about the concept of Pareto's principle. Okay, the Pareto works on 80-20. I will talk about 90-10 now. What that means is that Pareto applies everywhere, be it your personal life, be it your professional life, be it your investment, be it your property, working in everywhere. It says that 90% of your income come from the 10% of the top investment that you have done. So if you can see if you have invested, suppose say for example 20 different stocks right away, so top 10%, top 10 or 20% will actually is giving you 80% revenue. It applies to anything. Okay, it applies to everywhere and everything, irrespective of whatever things you can consider. It's a general law, which is a universal law which applies. So what I mean to say that do not have a wide range of diversification. If you have 50 stock investment, 50 mutual fund company investment, the top only 10 to 20% of companies or stocks which have invested is giving you return of 80%. Rest there will be a loss making. So do not divert so much that is very difficult. Even in industry also, if you pick an industry, suppose if you pick FMCG industry, so there are only multiple companies in the FMCG industry. Don't go on investing each and every company. You have to always remember that in FMCG industry also Pareto principle apply. Top 20% company will be earning 80% revenue of the total industry. So you have to find out what are the top 20% companies out there and then invest in 1 or 2 companies out of that. So that is the principle you need to take into consideration, so that you can, even if you're diversifying, you're well aware and you're well in the scope of this Pareto's principle. Moving on, should we invest in gold? Well, I have been giving you a very sharp call of investing in gold right now. But gold recently had a little bit corrected because of rupee and rupee depreciating and dollar getting strength. But right now, gold I will always mention that keep it as a strategic investment point. China is accumulating gold a lot. We have seen that before Ukraine and Russia war, Russia is actually accumulating a lot of gold, and because of the US interference in the Russia-Ukraine war, they are seizing so much of wealth of Russia across the globe. Most of the countries, they are gradually reserving gold a lot. So that's why I can presume that you should have a 10% exposure of your total asset in the gold, because in the long run, it, the price may not deeper correct, because China is already accumulating a lot of gold, and that's a clear indication what they're going to do with Taiwan probably 1 or 2 years from down the line, because China also knows that if they do something activity with Taiwan, what US is going to do. That's why they have started putting out a lot of gold reserve into their currency, so that it's a hedge against US supremacy of dollar. So you can put up a little bit of gold correction although in that thing. I will not spare much time. I already mentioned all those points. Crypto, well, you have seen that crypto market has crashes. There has been a talk of 28% GST, apart from other taxation which has already been applied here in crypto. So crypto, well, it has been corrected a much. The top two players, Warren Buffett and this player is already mentioned, Munger has already mentioned that even if the crypto price fall, Bitcoin price fall to $25, I will not buy it. Well, it has been a lot of ambiguity still out there. So if you are aware of the product, if you are aware of the concept, you can have a little bit of exposure. But right now, I will not recommend, because in the next 3 to 4 years, Indian stock market look extremely attractive than all other factors which is there out here. And even if you do not know the technology, you will have a high chance of getting robbed out of that. So stay away from that as of now, because government is having a very harsh reality, hard stance and hard look about all those cryptos, exchange and all those things. So alternate investment equities is going to give you a much better return. So look for that options. So debt market outlook, as I show you the inflation numbers, you see the inflation, as I mentioned, Turkey's inflation is amazing, like 60% inflation. Can you imagine? Argentina, you see the inflation number out here. It's India is 7.7%. It's much lesser around here. Its level. So all those countries which has a bigger dependency on commodities and crude, Russia, Ukraine, they have impacted deeply out of that thing. So we are still better off if you see the global consideration. And RBI reaffirm inflation over growth. So we have seen those correction happening. Interest, I mentioned all those points. Rate hikes, inflation are taking preference over growth. I mentioned all you that across the globe they are cutting down. They want to cut down the inflation number, increasing the rates. Obviously, this 60% is not sustainable. It will go in a Zimbabwe way if Turkey continue for another couple of months from here itself. So they have to increase their interest rate. So that's what's happening. And I quickly move on. We've seen that RBI surprised the market. I already mentioned you at the beginning. And reducing, as I mentioned, CRR high expected to withdraw liquidity to 80,000 crore, 87,000 crore to the market. The 7.7% which the inflation number has come, you're going to see a drop in next quarter result. It is a debt outlook, most of which I've already mentioned to you. If you are investing in debt, invest in a floating rate instrument. Okay, don't go for a higher bond paper right now. Higher bond paper means the RBI bonds, the 5-year, 10-year bonds or every kind of bond, which is a longer paper. Don't go over the longer paper. You know why? The reason why I say that whenever you have a chances, as I mentioned, there is a chances of interest rate hike. So if the interest rate increases, the existing bond yields drops down. So if you are buying a bond which is of a higher paper, right now you're going to see a negative return in next 6 to 12 months kind of thing. So don't go with a fixed instrument of a higher duration maturity paper. Go with a floating rate instrument. There are paper which are floating rate instrument which will give you a better return irrespective of the market moving anywhere directions itself. Okay, because they will catch hold of the higher interest rate also. So debt opportunity I already mentioned. Indian debt to GDP ratio is relatively low as compared to regional peers. Key variables, this point I already mentioned on and off as I present to you, and this is already mentioned all those points to you. So that is on a nutshell. So on a summary, what I can tell you right now is that global economy is on a downfall. They are in a recessions. Indian economy as such, they're looking very strong. Only the crude point is important. There's two important points. One is the higher crude oil prices, which I already told you that takes 7 to 10 years. You don't have to worry about crude prices at all because of the alternate options available. Even in the short term, till this war goes on, the crude will hover around over $100 as such. Once the war cools down, you can see the impact of crude coming down very sharply from there, and Indian equity market reverses. The inflation, as a result of the crude, RBI is already taking steps to increase. We can see a much higher interest rate hike from here also onwards in next 2 to 3 months time. So for the next 5 to 6 months, you're going to see a market remain volatile, and as such, post that, probably once the inflation cools down, or the war itself will cool down in 4 to 5 months kind of time, then probably you can see a huge growth coming up, because FII, which have been flowing out of the market, will come back again very, very strongly. And once the FII come back, the 53,000 level, what you're seeing right now, I am seeing 70,000 level from here in next probably 2023 end onwards. So from 50,000 to 70,000, it's a clear 40% hike what I'm seeing in a benchmark index, what I'm talking about. So you can imagine the particular stocks, bonds, investments, mutual funds, how much return they're going to give. So I will recommend you till now. You might have remembered that from the October onwards, I have been telling you very cautiously, don't invest much, look for the asset allocation kind of product and all those things. But right now, I have changed my stance. Put your money aggressively on equity, not on one go, but spread in load 4 to 5 months. This is the time which you can actually make money, a lot of money in days to come. Probably in next 2 years kind of thing, if you have a duration kind of thing, you're going to make a great amount of money as such. Okay, so that's from my side. If you are interested to select how to select stock of your own, do join me in the Friday sessions. Very, very basic sessions about how to select stock of your own. Okay, I have taken the sessions earlier also. A lot of participants were there. I will drop you the message in the group. If anyone of you interested can join that. And if you have any query, you can drop me in my WhatsApp in a personal. I will get back to you. Otherwise, I will take off from now. Stay healthy and stay safe and stay invested, and try to invest more at this point of time, not at one go, but spread across in different times in 4 to 5 months from now. Thank you very much. Thanks.